So let's break this down. So what we're trying to do in traditional value investing is buying companies through the stock market. So we're buying a share of a company, but we're going to pretend like we own the whole company even though we own a small piece. But we're pretending like we own the whole thing. So we're buying companies for substantially less than what they are conservatively worth, and holding them until they're overvalued and selling them then for a pleasant gain. So let's break this down. Buying companies means we're purchasing their stock through the stock market, but even though we're buying individual shares of the company, we pretend like we're buying the whole company. So we just imagine in our head like we're buying the whole company, just like you would buy a pizza shop or something. We're buying companies for substantially less, meaning there's a value to the company. There's what the company is worth. That's the value. The value is what the company is worth. And then there's the price. The price could be substantially discounted from the value, and that's what we're looking for. We're looking to buy companies for substantially less than what they are conservatively worth. That is the core philosophy and core principle of traditional value investing. Buying companies for substantially less than what they are conservatively worth. So if we estimate a company is conservatively worth 500 million, we want to buy it for substantially less, like something like 200 million is what we want to pay for it. So there will be times when there are inefficiencies in the market. An inefficiency is when there's a substantial gap between price and value, and we're looking to exploit those inefficiencies. We're looking to exploit inefficiencies between price and value. So let's say a company, like I say, is worth 500 million, but it's selling for 200 million. That is a substantial difference between price and value, and we're looking to exploit the market by buying those companies and then holding them until the market corrects that inefficiency. So what will happen is, let's say a company is worth 500 million, but it's selling for 200 million. What will happen, probably 70 or 80% of the time, is the market will then drive the price of that company back up towards what it's conservatively worth. So we got to first be able to estimate what a company's conservatively worth. Once we do that, once we estimate what the company is conservatively worth, then we're looking to buy companies that have a substantial discount or selling for substantially less than what they're conservatively worth. So keep in mind that the core principle of value investing is buying companies for substantially less than what they are conservatively worth, holding them until they are overvalued, and then selling them for a pleasant gain. Now keep in mind, let's say you find a company that you think is worth 500 million, right? And it's selling for 200 million. If the company corrects that, you double your money at least, basically. So there's no reason why, and that'll typically happen within about 18 months at most. So there's no reason why, as a value investor, if you can find multiple companies like this and you can buy them and hold them, right? There's no reason why you won't, be able to double your money basically every 2 years. That is very feasible, provided that you're able to find companies that are selling for substantially less than what they're conservatively worth. And we're not talking about 1 or 2, we're talking about a good chunk of maybe 5 companies, 10 companies, 15 companies, and holding them until they're worth, basically until they're selling selling for closer to what they're actually worth. So keep in mind that the core principle is buying companies for substantially less than what they're conservatively worth, holding them until they're overvalued, and then selling them for a pleasant gain. Thanks for tuning in.